Are you on track to max out your 401k, or will income limits cut you off? If you're a high income professional, you could be reaching your income limits that shut off your 401k contributions long before you realize it. My name is Abrin Berkemeyer. I'm a senior wealth manager at Willis Johnson Associates, and we see this all the time when people come in to meet with us. Let's run a quick audit to make sure you're not leaving money behind. The IRS sets a few important limits each year when it comes to your 401k. One is how much you can contribute as an employee, either on a pre-tax, Roth, or after-tax basis. And another is the maximum amount of income that can count towards those contributions. This is known as the 401A 17 limit. If your income crosses this threshold too early, you could be cut off from making 401k contributions. And your employer and their employer match can be too, without warning. So where do you find these limits? These limits change every year, and to find them, go to the IRS website and search 401k contribution limits. Or check with your HR portal or retirement plan documents for this year's numbers. Knowing these limits is the first step. The second is making sure your paycheck and contributions stay on pace to hit them. Let's consider an example. You're 51 years old and your goal is to get $30,000 into the 401k. At the beginning of the year, you take $30,000 and divide $600,000 to get to your 401k contribution percentage of 5%. Fast forward to June, chances are income limits are right around the corner, especially if you've had a big bonus in the spring. If you're at $300,000 of income already and at $15,000 in 401k contribution, it seems like you're on the right track, right? Not quite. It's time to rethink the calculation. If the income limit for the year is, say, $350,000, then instead of getting $30,000 into the 401k with your 5% contribution rate, you'll actually get cut off early only at $17,500. So what can you do? Look at the equation. If your expected income amount is over and above this year's income limits, your calculation should actually look something like this. Total 401k contribution amount divided by this year's income limit equals how much you need to contribute to get the max out of the 401k this year. If you're looking at your 401k contributions in a platform like Net Benefits, first take a look at the year-to-date contributions on your statement, and then determine your remaining 401k contribution amount for the year. Then check your pay stub and see how much income and how many pay periods you have left before you reach the income limit. Finally, take your remaining contribution amount and divide it by your remaining income available. That tells you the percentage you need to adjust your contributions to if you want to reach your 401k contribution goal for this year. Here's where it gets tricky. If your compensation passes the IRS income cap for the year, your employer also gets cut off from contributing to your 401k. Some companies like Chevron, BP, Shell offer non-qualified 401k plans to make you whole, but those come with an added tax complexity and planning challenges at retirement. The only way to avoid falling short is to max out your contributions and get your full employer match before you reach the income threshold. If your salary or bonus plan has increased this year, chances are your 401k strategy needs to evolve to keep up. At Willis Johnson Associates, we specialize in helping Shell, BP, and Chevron professionals get the full benefits of their 401k plans while avoiding costly missteps that add up over time. If you like this video, don't forget to click like and subscribe for more educational videos like this. If you want a second opinion or a second set of eyes on your 401k contribution strategy, click the link below to request a meeting with one of our fiduciary advisors. We'll help you stay ahead of the varying IRS limits, get the full contribution or match from your employer, and help you stay on track for a more confident retirement.